You deposited your paycheck last Friday. You watched the numbers appear on your screen. You felt Safi secure. You believed that money was yours. But what if I told you that the moment your dollars entered that bank account, they stopped being yours? What if I told you there is a law passed quietly, buried in thousands of pages of legislation, that says when the next crisis hits, your savings can be taken to save the very bank that lost it? Not stolen, not seized, legally converted. And you agree to it without ever knowing this is not a warning about what might happen. This is the revelation of what already did happen, what was tested, what worked, and what is now waiting ... for the next collapse. The year was 2013. The place was Cyprus, a small island in the Mediterranean, a banking paradise, a quiet corner of Europe where wealthy Russians parked their fortunes in ordinary. Cypriots trusted their modest savings to institutions that had stood for generations. Nobody saw it coming. Nobody was warned. And then, one Friday night, everything changed. The banks closed. ATMs stopped dispensing cash. Credit cards were declined. And when the Cypriot people woke up on Saturday morning, they discovered something that would rewrite the rules of banking forever. Their government, in coordination with the European Central Bank and the International Monetary Fund, had announced that deposits would be seized to rescue failing banks. Noce taxi, not penalties. Seizure. The original proposal demanded 6.75% from insured deposits under 100,000 euros and 9.9% from everything above. Imagine that. You save your entire life. You follow the rules. You trust the system. And one morning, nearly 10% of everything you have is simply gone, taken, not to pay a debt you owed, not to fund a war you supported, but to rescue banks that had gambled with your money and lost. The people of Cyprus filled the streets. They pounded on bank doors. They demanded answers, but the doors stayed closed for almost 2 weeks. When they finally reopened, the rules had changed slightly, but the principle remained: uninsured depositors, those with more than 100,000 euros, lost up to 60% of their savings. 60%, decades of work, retirement funds, business capital, children's education savings, gone, converted into worthless bank shares in institutions that were already dead. And here's what should terrify you. Cyprus wasn't a failure. Cyprus was a test, a successful test. The template was created, the mechanism was proven, the world watched, ... and took notes. But let's go back further. Let's understand how we arrived at a world where your bank deposit is no longer your property, but a loan you've made to a corporation that can legally refuse to pay you back. 2008. The collapse that shook the foundations of global finance. Lehman Brothers. Bear Stearns AIG, names that had symbolized invincibility, suddenly became synonymous with catastrophe. The American government responded with bailouts ... $700 billion of taxpayer money injected into failing institutions. Banks that had created toxic assets. Banks that had packaged worthless mortgages into complex instruments and sold them as gold. These banks were saved. Their executives kept their bonuses. Their shareholders were protected. And the American people, the ones who had played by the rules, paid their mortgages, saved responsibly. They paid the price. The outrage was immense. Occupy Wall Street, Tea Party protests, left and right united in fury against the system that privatized profits and socialized losses. Politicians promised change. They promised that never again would taxpayers bail out reckless banks. They promised accountability, reform, justice, and they delivered something, but not what you think. In 2010, the United States Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. 2,300 pages of legislation, the largest financial reform since the Great Depression. It was celebrated as the end of Too Big to Fail. The media praised it. Politicians took victory laps. The banks, they stayed quiet, because buried deep within those 2,300 pages was something extraordinary, something that most Americans have never heard of. Title II, the Orderly Liquidation Authority. This provision did exactly what the politicians promised. It ended taxpayer bailouts, but It replaced them with something far more sinister. It replaced them with, instead of using public money to rescue failing banks, the law now authorized using depositor money, your money. You see, when you deposit money in a bank, you are not storing it. You are lending it. Legally, you become an unsecured creditor of that institution. The bank owes you that money, but only if it can pay. And under Dodd-Frank, if a bank becomes insolvent, the FDIC can convert your deposits into equity, into shares, into ownership stakes in a bankrupt institution. They can haircut your savings to save the system. But wait, What about deposit insurance? What about the FDIC guarantee? Isn't everything under $250,000 protected? Here's the truth. They don't advertise. The FDIC insurance fund contains roughly $120 billion. The total insured deposits in the United States exceed $10 trillion. That's a coverage ratio of barely 1%. If a single major bank fails, Bank of America, JP Morgan Chase, Wells Fargo, the insurance fund would be exhausted in hours. And then what? Then the bail-in provisions activate. Then your savings become the solution. Are you beginning to feel it? That creeping realization that the safety you believed in might be an illusion. If this is disturbing you, if you're starting to question everything you thought you knew about your own bank account, stay with me, subscribe now, because what comes next will show you that this isn't just American policy. This is global. This is coordinated, and this is already in motion. The Financial Stability Board. Have you heard of it? Most people haven't. It was created by the G20 in 2009, a shadowy international body headquartered in Basel, Switzerland. Its mandate to coordinate financial regulation across the world's largest economies. Its membership, central bankers, finance ministers, and regulatory officials from 25 countries. Its decisions, not laws, exactly, but standards that member nations are expected to implement. And in 2011, this unelected body issued a document that would reshape banking forever. They called it Key Attributes of Effective Resolution Regimes for Financial Institutions. Translated from bureaucratic language, this document established the global framework for bailing. It mandated that every major economy create legal mechanisms to convert depositor funds into bank capital during crises. Not as an option, as a requirement. The United States complied with the European Union complied with the Bank Recovery and Resolution Directive in 2014. Canada complied with provisions buried in their 2013 budget. Australia, Japan, every major economy signed on. This wasn't a conspiracy in the traditional sense. It was published. It was official. It simply wasn't explained. The mainstream media didn't investigate. Politicians didn't debate it publicly. The implications were never laid bare for ordinary citizens to understand. And so the trap was set, in plain sight, while everyone looked the other way. Let's return to Cyprus for a moment, because what happened there revealed the mechanics of modern financial confiscation. When the bail-in was announced, the Cypriot government imposed capital controls. Citizens were limited to withdrawing 300 euros per day. Wire transfers abroad were frozen. Businesses couldn't pay foreign suppliers. The economy seized like an engine without oil. People who had committed no crime, violated no law, were suddenly prisoners of their own bank accounts. Their money existed, In theory, but they couldn't access it. They couldn't move it. They couldn't protect it. And here's the detail that should haunt you. The decision was made on a Friday night. By Monday morning, it was done. There was no warning, no gradual implementation, no time to react. The people who had their savings on Thursday, had significantly less by Sunday. Speed was the weapon. Surprise was the strategy. Because the architects of bail-ins understood something fundamental. If people knew what was coming, they would withdraw their money. They would collapse the very banks the policy was designed to save. So the system requires secrecy. It requires that you don't understand. It requires that you keep your money in the bank, trusting in guarantees that cannot be honored, believing in protections that exist only in theory. Would you keep your entire life savings in an institution that has legal permission to take it when things go wrong? But perhaps you're thinking, that was Cyprus, a small country, a unique situation. Surely the major economies are different. Surely America is different. Let me tell you about the stress tests. Every year, The Federal Reserve conducts stress tests on the largest American banks. These tests simulate crisis scenarios, severe recessions, market crashes, geopolitical shocks. The banks must demonstrate they can survive, and every year, the Fed publishes results showing that the big banks are strong, resilient, safe, but what the headlines don't mention is what the stress tests actually measure. They measure whether banks can survive using bail-in procedures. The scenarios assume that depositor funds can be converted, that creditors can take losses, that the legal mechanisms created by Dodd-Frank will be deployed. The stress tests aren't proving that banks won't fail. They're proving that when banks fail, your money is available to absorb the losses. This is not speculation. This is the stated methodology published by the Federal Reserve, available to anyone willing to read the technical documents that nobody reads. And then there's the question of derivatives, the shadow obligations that lurk beneath the surface of the banking system, like monsters in the deep. The largest American banks hold derivative contracts valued at hundreds of trillions of dollars. JP Morgan Chase alone carries over 50 trillion in derivative exposure. These are complex financial instruments. Bets on interest rates, currency movements, credit events. When they go right, they generate enormous profits. When they go wrong, they can destroy institutions overnight. And here's the crucial detail. Under current bankruptcy law, derivative counterparties are paid before depositors. Before you, if a bank collapses, the hedge funds and financial institutions on the other side of derivative contracts get paid first. You, the depositor who trusted the bank with your savings, you stand at the back of the line, behind the gamblers, behind the speculators, behind the very parties whose risky bets may have caused the collapse in the first place. Is your blood beginning to boil? Is something shifting in the way you see that bank balance on your phone? History teaches us patterns, and the pattern here is unmistakable. 1933, Franklin Roosevelt closed the banks for a holiday. When they reopened, gold ownership was effectively banned. Americans were required to surrender their gold to the Federal Reserve at a fixed price, then watched as the government immediately revalued gold 40% higher. A wealth transfer disguised as emergency policy. 1970, Richard Nixon closed the gold window. The dollar's last connection to real value was severed. The currency became pure faith, and that faith has eroded by over 95% since then. 2008, the bailouts, public money to rescue private failures, the template for using crises to concentrate power and transfer wealth. 2030, Cyprus, the test case for Berlin's depositor money to rescue insolvent banks. The mechanism proven, the resistance measured, the conclusion, it works. And now, we wait for the next crisis, the next emergency, the next Friday night announcement that changes everything. But what can be done? Is there any way to protect yourself when the very act of saving money makes you vulnerable? Some have turned to physical cash, keeping portions of their wealth outside the banking system entirely. But the war on cash is accelerating. Governments are eliminating large denomination bills. Surveillance on cash transactions is intensifying. The option to exist outside the digital financial system is being systematically closed. Others have turned to gold and silver, precious metals that have stored value for 5,000 years. Assets that exist outside the banking system. They cannot be bailed in. They cannot be digitally confiscated. But physical possession matters. Gold in a bank vault is still subject to bank access. Gold held personally is one of the few true forms of private property remaining. Still others have diversified internationally, spreading assets across jurisdictions, making it harder for any single government to access everything. But this requires resources, knowledge, and careful planning that most people don't have. The fundamental truth is this: the system is designed to make escape difficult, to keep your money where it can be accessed when needed, not by you, but by those who control the levers of financial power. Have you ever wondered why financial literacy isn't taught in schools? Why the mechanics of banking remain mysterious to most people? Why the legal status of your deposit is never explained when you open an account? Ignorance is the foundation of the system. If you understood that your bank deposit was a loan that might not be repaid, would you still deposit it? If you knew that laws had been passed to take your savings during the next crisis, would you still keep everything in one place? If you realized that the insurance protecting you covered less than 1% of total deposits, would you feel safe? The Vault of Secrets exists because knowledge is power, and those who hold power have every incentive to keep you in the dark. But you're here now. You're learning. You're seeing the architecture of a system built to protect itself at your expense. The next financial crisis is not a question of if, but when the global economy carries more debt than at any point in human history. Interest rates have been manipulated for decades. Asset bubbles have been inflated and the derivatives market dwarfs the real economy by orders of magnitude. The kindling is stacked high. Only the spark is missing. And when that spark ignites, when the next Lehman moment arrives, the bail-in laws are ready. The procedures are in place. The legal authority exists. Your deposits are pre-positioned to absorb losses, and you will have no warning, because warning defeats the purpose. What would you do if you woke up tomorrow and 40% of your savings were gone? Not lost to bad investment, not stolen by criminals, legally converted to save a bank you didn't choose to bail out. Would you accept it? Would you protest? Or would you finally understand that the game was rigged from the start? The founders of this nation built a system of checks and balances because they understood that power corrupts. They divided authority because they knew that concentration leads to tyranny. But over centuries, financial power has concentrated beyond anything they could have imagined. A handful of institutions control trillions. A small network of regulators and bankers make decisions that affect every human being on Earth. And the laws that were supposed to protect you have been rewritten to protect them. This is not a call to panic. Panic serves no one. This is a call to awareness, to understanding, to the kind of informed action that only comes when the blinders are removed. Your money, your savings, your financial future. These were never as secure as you believed, but now you know, and knowledge, properly applied, is the beginning of protection. The bail-in laws exist. The mechanisms are ready. The precedent has been set. The question is whether you will take steps to protect yourself before the next crisis, or after, when it may be too late. If this has opened your eyes, if you're sitting there reconsidering everything you thought you knew about banks and safety and where to keep your hard-earned wealth, then you understand why we do this. Why we open vaults that were meant to stay closed. Why we reveal what powerful interests prefer to keep hidden. And if you want to know what else they haven't told you, if you want to understand the next layer of this financial matrix, then subscribe. Because in the next episode, we are going to reveal how the Federal Reserve was created in secret on a private island by 7 men who controlled 1/4 of the world's wealth. And how that midnight meeting in 1930 shaped every economic crisis that followed. The vault remains open. The secrets are waiting. The only question is whether you're brave enough to keep looking.